There he is. And we did a private credit event during COVID, right?
Okay.
And now here we are. Ilya, I'm gonna. I know you're sitting not with us, but you are. So I'll let you lead.
Thanks, Mark. Yeah, it was a real pleasure doing the first private credit summit with you 4 years ago. During COVID, you can say that it was an entirely online event, and it's great to see your network grow by so much. I've been based here in Monaco for almost 10 years now. Um, as a CIO of a single family office, my mandate there was to generate highly defensive returns, and private credit was the way to do it. We were shooting for just slightly above market returns while being senior. And the way we uh, achieve that is by doing co-investments with selected GPs while also investing rather small tickets as LPs. And also entering into various side letters, SMAs, and such. We ended up doing uh, close to 50 deals over the span of 6 years. Only two of them were MES, the rest of them were senior. And our preference is the US, followed by Asia, and only then comes Europe, given that the cost of capital in Europe has always been lower. It was great getting to know many managers in the process. I actually left the family office end of last year, and I'm currently a senior advisor to one of the GPs, and considering my next move as a family office allocator. Um, yeah, in general, I would look at the world of private credit as follows. 70% of it are really large funds doing large, predominantly sponsored deals. And these are the, these deals were never hugely attractive to begin with in terms of returns. The covenants have been rather loose. Uh, and there's obviously a lot of competition in the space as well. And with at the same time, these are the firms that have the marketing budget. They have pretty established names, and whenever you go to conferences, chances are that you'll be hearing from these funds the most. And 30% is the rest. And these are the funds that are offering often differentiated strategies. So with that, I'm very pleased to present our panel for corporate credit, uh, all of which are the funds that are generating alpha. They are not operating in the mainstream, and they have a lot to share. Um, and so why don't we start with Mountain Capital?
Sure. So what do you want to do? You want me to?
We could put the mic here.
Yeah, we can just do the round of introductions.
No, the round of introductions. Sure. Awesome. So Crane Deary, Star Mountain Capital, managing director. Been there about 3 years. I work on both the investment team doing direct investments, as well as on the capital markets team, bringing in all the counterparties into our deal, whether they're senior, pari, or behind us. I've been doing this about 20 years, starting in 2004 with Mary over at GE Capital. Then went through a joint venture with an investment bank and an insurance company, publicly listed BDC, and then an SBIC fund. So I've seen it in a number of different flavors, fund structures, and really settled in Star Mountain because of the focus on the lower middle market, but bringing scale to that equation, which a lot of players have not been able to do.
How's it going,
Thanks,
Morgan
Brendel.
Jones?
I should also mention that I've done at least a dozen of deals with Star Mountain as a co-investor and was also an LP in one of their funds. So next on is Morgan.
I have. How many deals? Joking. Go ahead, Marty.
Yeah. Hey, how's it going? Morgan Jones, co-founder of Wilmore Capital. We're a private credit fund focused specifically on the revenue-based funding sector, which is really more of a royalty-like security versus a loan. Focus on the small and mid-business sector. My business partner, Bill Airy, sitting in the room today. He runs one of the highest volume small business lending brokerages in the US, and my background's in private equity, private infrastructure investing. So worked at Digital Bridge Partners Group, and do some consulting for Monroe Capital. Nice to meet everybody.
Great.
Good afternoon.
Our third GP, Dan Fruman, unfortunately got the flu, and so he's not joining the panel. So I guess but we have Dixon, who represents the buy side, I guess.
Exactly. I'm Dixon Hayes. I'm with a single family office. I've been sort of in the family office world for about 15 years. Previously was on the hedge fund side. And so we have a pretty broad mandate in that we invest in managers and we invest in direct deals on our own, and we co-invest with managers. So we sort of look for folks who we can partner with repeatedly and sort of build a real kind of long-term relationship with, and really kind of focus on smaller niche areas. We don't want the broad generalists necessarily. We can build sort of a portfolio of sort of sector or specific expertises and kind of consolidate that into a larger portfolio.
Great. So just as a way for everyone to better understand um, your what you do on a daily basis, perhaps each one of you could describe a recent deal or a typical deal. What does it look like for you? Randall.
Sure, I'll kick it off here, but I'll say, more than often than not, we're the first institutional capital into the company. We're frequently partnering with experienced operating teams. That includes the owner or the founder, and we typically have an equity partner, whether that be a funded sponsor, an independent sponsor, or rollover equity from the former owner. Our structures always start with senior secured term loans, but we frequently have equity upside in the form of structured preferred. Our companies are 100% US based. They're all private, between $5 and $50 million of EBITDA. We're generally industry agnostic. We focus on high free cash flow generating businesses, predictable revenue, and defensible market positions. Examples include business services, critical infrastructure, healthcare. What we don't do is real estate. We don't do commodity linked industries like oil and gas, and we don't do gray markets like crypto or cannabis. Most common use of our capital is for growth or for acquisitions.
Thanks. Yeah, so like I mentioned before, most of our focus is in the small and mid-sized businesses. So we earlier today when we were pitching, 80% of small business loans applications get declined by traditional banks. So our fund is filling the gap to support these small and mid-sized businesses throughout the U.S. Typical use cases for that the small businesses use our money for is, let's say they win a big purchase order, need to buy inventory, we'll pay down our facility with the fulfilling of that purchase order. Or let's say they're bridging to a larger permanent capital markets event, whether they're raising debt or equity, that could take anywhere from 3, 6+ months to close. We can provide them that bridge financing to get them from point A to point B. Or let's say they want to acquire a competitor. Like I mentioned before, our product is not a loan. We're actually purchasing a percentage of a company's revenue at a discounted rate. So let's say a company comes to you and says, we're looking for $1 million. we say, okay, we'll purchase $1.3 million of your future revenue, and that's repaid on a daily or weekly basis over a 3 to 12-month term. So high velocity of cash flow compounding and principal recovery, as well as very short terms, which provides us a lot of agility to pivot towards industries that are experiencing tailwinds and away from industries facing headwinds.
We don't really have typical deals. As a single family office, we're sort of investing all over the place, and usually we'll partner with managers who know those spaces better than we do. But when we do go direct, we've sort of found an interesting niche where we partner with venture and growth equity sponsors, and we'll come in on the private credit side as sort of that bridge capital, or if they're looking for $5 or $10 million, so they're not going to go for kind of a large institutional manager. So we'll sort of leverage the relationships we have with the equity sponsors and come in and just be that flexible capital where frankly those companies are really starving for funding, and especially less dilutive funding.
It's a smart strategy. Plus you guys have M&A.
So the next question goes to the heart of your role as a capital allocator. How capitalized is your niche, so to speak? What's your fundraising outlook if you're a fund? And what would you do differently if you had 10 times the amount of capital that you have now?
Sure. Well, I'll start out again on this one. But we believe the lower middle market, it's underserved. The banks have largely pivoted, although they haven't left the space. They just approach it at a different angle, and they're really as much partners now as they are competitors, whether they're coming into our deals as revolver lenders, first out term, whether they're up in our fund level leverage facilities, whether they're LPs in our funds. And so they've really kind of pivoted within the space, right? But our strategy is somewhat consistent here on what we're trying to do. We're trying to be a capital solution provider and value-added partner to the lower middle market, right? And we believe that offers the best risk-adjusted returns. And so what we've been doing on this is usually what happens in this end of the market is people raise capital and they end up moving up market and doing bigger deals because the leverage, the labor is not scalable in this. It takes as much labor to do a smaller deal as it does a bigger deal, right? We're trying to crack that code by building more efficient people, processes, and systems, and invested heavily in that, and currently in that, whether it be reinventing our data architecture, building out new processes, and introducing some of the new technologies such as AI, that just reduces the amount of time we spend looking for information. But the process is pretty straightforward in there. The focus is always on that. The fundraising environment is improving. It's a little bit choked up, as we know, just given the amount of distributions that have gone back to LPs. I think that's starting to restart a little bit here. We've built some momentum. We're in the market with 3 different funds right now, and we're getting good traction.
Yeah, so I would say we're a very niche asset class within the private credit space. As of 2023, I believe the total market size was about $23 billion, expected to move up to $44 billion by the end of 2031. There's a lot of players in the space. There's institutional capital, both on the investor side as well as the lender side, facilitating these transactions and backing the funding companies that are offering this product. I would say from a capital raising perspective, I think where we differentiate is one, diversification. We are going to have exposures to about 300 to 500 underlying RBFs across business models, industries, geographies, et cetera. Obviously, all within the U.S. The repayment frequency is daily or weekly versus a traditional loan where you have payments every month and it's a 3 to 7 year term. Our terms are 3 to 12 months, repaid daily or weekly. And we can offer 14 to 16% annual yields, 17 to 22% net IRRs, which is definitely alpha relative to some of the other private credit funds out there. If I had 10 times the capital I did today, I would just execute the same playbook, focus on diversification, limiting concentration risk, making sure that we have proper exposure to the right industries that are going to be doing well now and in the future, and we have the ability, like I said earlier, to switch and very quickly pivot, just given the short-term nature of our funds.
This question probably isn't down my alley. We're all internal capital, so we're not fundraising, which I'm thankful for, and I feel for all of you who are fundraising. It's hard. Yeah, so probably can go to the next one.
But Dixon, if you were managing a lot more capital than you do now, and that's a dilemma for billion-dollar family offices.
Yeah,
What would you do differently?
it is, and in some ways, having sort of a defined capital base can make it a little bit easier because we can sort of stick to the to certain types of strategies and sizing. Because if we were 10 times bigger, I would say we'd have to be really owning and operating multiple businesses, and we're not equipped to do that, candidly. And so it would be a totally reimagined investment strategy, because the deals that we do tend to be a little bit nichier and smaller, and so we could scale them by doing more of them, but then we get into a little bit of adverse selection, and I'm not as interested in going kind of up market in terms of deal size. So so I actually sort of like where we are. Having 10 times more capital, I guess we'd figure it out, but probably dilutes the returns a little bit.
Yeah. Um, uh, Randall, which metrics are you monitoring on a quarterly or perhaps even monthly basis? Where are they trending, if they are in fact trending? And does that give you any crystal ball into the state of certain industries, or maybe even the economy as a whole?
Yeah, so I'd say we're pretty active managers of our portfolio companies. We get monthly reporting. We sit on all the boards. I probably talk to these guys at least once a week, whether it be the CFO, the CEO, or the head of sales. So we've got pretty good visibility. As far as the general KPIs, we're always looking at revenue, gross margin, EBITDA trends, what the liquidity is, what the coverage ratios are, what the macro industry trends are. And then across every portfolio company, we've been going across the big three right now, which is tariffs, immigration, and government spending. But as far as companies, the specific portfolio companies, we do have very specific KPIs associated with the operating metrics for each portfolio company that we track on a performance basis. We also track them where they are and what we call getting middle market ready. So as we're institutionalizing these businesses, where they've gotten their finance function in order, do they have the right person in the sales function? What are they doing with their ERP system? All those types of things that we track to get them up and get them ready to exit in the middle market where the multiples are higher. So we definitely stay on top of that. As far as the crystal ball is concerned, through year end, I think we were pretty good. Obviously, there's been a lot of turbulence. We've got government contractors in the portfolio, so obviously we're working through that. That's been pretty interesting. On the insight side, we've got like Ben Carson's on one of our boards, and so we're getting pretty good intel into what the discussions are within the government. And I think the answer to that is no one really knows, right? There's a lot of repositioning and all that spending. There's a lot of turbulence that we're trying to work through on some of those portfolio companies on that side. But outside of that, I'd say we've been in a pretty good position. I think there's a lack of some of the decision making right now has been paused. Just because people don't have the conviction on what they're doing. And then there's some of the other guys that are really going on offense and view this as a time where they can get busy, and there's some competitive weaknesses. I was just out at a portfolio company, and I was talking to one of them last week out in LA about rental. Obviously fires impacted that business, but it also impacted their competitors. And my view is like, let's go play offense in that environment. We should be able to go pick up some of their best salespeople and various other stuff with some of those guys, because they're not as well capitalized or equipped to manage through that process where our group should be, right? So I think we're looking for opportunities to play offense selectively. But as far as taking on risk, we just closed one in the behavioral space, an autism platform. We're looking to bring on actually some co-investors on that space. And so working through things there like Medicaid risk, right? And people are trying to get their hands around that. It's obviously different than the other parts of Medicaid, but there's a headline risk there. And so you got to sell through some of that stuff as well. But that's the general thought that we're feeling so far.
Yeah, so our primary focus is on the revenue growth and revenue consistency of our companies, and just given the daily and weekly repayment schedule, we're the first person to know if that business is running into trouble or their revenue's decreasing, running into issues, and you can immediately execute a workout plan to try to kind of help them either extend the term, lower their payments. And if that doesn't work out, obviously you can go into more legal action for breach of contract, issue UCC liens, et cetera. So our focus is primarily on the revenue piece. We're an emerging manager. We're in the capital raising mode now. Haven't started deploying yet, but a lot of the deals that we're seeing across the industry is consistent from industry perspective. So construction's a big one, retail, healthcare. Some of the industries that we're seeing pullbacks on is real estate and transportation. So we just monitor the macroeconomic factors. Obviously, tariffs is top of mind for a lot of folks. So in the event that, I mean, we hear something different every day, but in the event that there's more confirmation on which industries are going to be affected, which industries are not, we can focus our capital deployment on the industries. So U.S. Manufacturing that has U.S. based inputs, U.S. customers, or industries that have inelastic demand characteristics such as healthcare, food production, energy utilities, et cetera. So we just keep a pulse on the overall market and kind of act accordingly.
Yeah, I would say on our end, we tend to favor the more defensive sectors, especially on the private credit side, and not surprisingly, with the folks that we lend directly to, we are in constant contact with them. We want to have a very kind of open and transparent dialogue. We're here to help. We're not here to take over their business, and we really sort of build the portfolio more from the bottoms up, really looking for good individual opportunities, whether that's a direct or a manager. And so we pay attention to the macro data, but we don't have sort of a slew of macroeconomists. So we just try to, not make dumb mistakes and try to be defensive. Again, we're sort of, the families created their wealth, and so we're trying to preserve and grow that. We're not really trying to look to take kind of undue risk to make a little extra cash.
Well, thank you for this macro insight. But more generally, what keeps you up at night?
Well, that sort of answers everything on that one. But I mean, literally, I wake up in the middle of the night thinking about these guys all the time. But I mean, I'd say it comes down to three main things. Do I have the right people in the right seats? Do we have liquidity, and are we getting accurate and timely information? I feel like if I can get those three things together, I can manage through almost the vast majority of circumstances with these companies. I mean, obviously there's some things you cannot, but I think those are the three main things that I talk about. So when I think about this stuff, I'm thinking, who's my guys in the seats? Who's sitting on the board? Who are the operators of this business? And do I trust them? Do I think they know what they're doing? Do these guys have sufficient liquidity to execute on their plan? And are they getting timely information to make the right decisions?
Yeah, so I think both the RBF market as well as our fund is pretty well insulated from a lot of the common things that could keep you up at night, just from a diversification principal recovery standpoint. One of the things that is kind of top of mind that is again uncertain is the new administration potentially rolling back regulations on the banks, which might create additional competition in our space, because the space is really taken off because the banks stopped lending to SMBs. But with that, we'll still be able to compete on timing to execute, timing to fund. Traditional bank could take, like I said, 2 to 4 months, maybe longer from initial valuation to funding. our deals get closed in as little as 24 to 48 hours. And that's by leveraging technology to look at the underwriting. You look at 3 to 6 months of prior bank statements, come up with annualized revenues, and it's purely focused on that. And then there's a human element of an underwriting team and principal call, a due diligence call to get further confirmation that it's a good credit story.
I'll offer sort of a slight spin on Crandall's answer, which I really liked, but I actually sleep pretty well because I've picked a bunch of good partners, and I think that is kind of echoing his point is the most important thing. Just really doing business with folks that you can trust, that you can rely on. They're going to make mistakes. We're going to make mistakes for sure, but that we're looking at it in the right long-term perspective, and that our interests are aligned. And so I think that, again, I'm comfortable with that, and I'm happy with that. There's all sorts of macroeconomic noise and events that, frankly, we have no control over. So try not to focus on that.
So I had a question on that. 3 qualities that you look for in the partnerships, the collaboration, and from the first meeting, as far as like, what's your due diligence on them? What's your process like?
Yeah, it's a good question. It is not a kind of uniform diligence process. So I think a lot of the time we meet our partners through kind of trusted intermediaries, friends, other family offices. So that personal recommendation carries a lot of weight. That's not the be all end all by any stretch, but a lot of the time we will, we'll start doing work with partners. Maybe we'll shadow a deal that they're working on, and then the next one maybe we'll invest directly into that deal. So it's a co-investment, and then after we do 1 or 2 of those, we would look to invest as a LP in their fund. And so that allows us to get to know them, get to see how they work, really kind of get to peer under the hood. It allows us to underwrite the deal and the manager. And so you could have a really good manager in an unattractive deal, or you could have a really great deal despite having kind of a manager that we're not that impressed with. Not a lot of managers are sort of, that's probably not their preferred way of going about it. They'd rather just have a check as an LP. But I do think, especially with the more specialized niche managers, they're much more open to that. And that's also just sort of candidly a sign for us that they're willing to work with us. They view this as a long-term partnership, as opposed to, I'm just trying to get this, these dollars into this fund, and then I'll worry about the next one later.
Yeah, I mean, I'll answer it from the people that we're investing in, meaning the companies and the operators and the owners and all that stuff angle, not the people that we're partnering with on the capital side. But it's a really interesting question. I think that's the area that we're really trying to figure out, how do we underwrite that better. It's probably one of the harder things to underwrite. I feel like we can get into an industry and get down to the root drivers and all that stuff pretty quick, right? And we've done enough deals and all that stuff. When you're looking at people, how do you underwrite people, right? And we're really trying to build that out. And we're getting down to where are these guys located? How often do they meet? Like, what's their family situation? Like, stuff that you're not even supposed to really ask. But, you kind of get into, like, what are the motivations?
The early day, one of the managers said they wanted their founders be connected with Apple Health apps.
Yeah, I mean, but seriously, like, there's stuff like that. I mean, so I work with a founder. Like, we're a founder-owned company. We're 100% employee-owned, and we're very similar to the people that we're investing in, right? And I can point to that. And that's like, this guy loves running Ironmans, and he thinks everybody should run an Ironman. So I'm like, I don't know if I can put that on the thing, but there's stuff like that. Like, how driven are they? What's their personality type? We've got like 3 different tests that we can run on that, right? Will it be the trimetric or this or that, right? And it's not necessarily just qualifier. It's how do you communicate with them? How do they communicate with other people? How are they building a team, right? And I've got 3 portfolio companies I'm working on right now that are all performing, that are all, there's something going on with the relationships that I'm having to manage to make sure that these things stay on the rails, right? And it's just silly little things, right? But it's important, right? And I've got, because I've got founders that have been in this, and he's a sausage maker, right? The guy doesn't know corporate finance. So you can't understand what some of the stuff that's going on. Yeah. It's personalities, you get the point.
Ilya, you want a final word, before we move to the next panel?
I'll let the esteemed panelists have the final word, which is very general question, and you may have addressed it in many ways as well. But how do you create this cycle agnostic strategy where you deliver consistent returns even in a somewhat volatile year like this?
That's not a final word. I think you have to boil it down to a sentence, because we have to move on. I think you probably got a paragraph of it.
I got a lot, yeah, no, I would say bring it down to structure, we stick on structure, right? We're senior secured, we don't over leverage, and we get good reporting information, we invest, we don't try to time the market, we just stay with, resilient companies and put on good structures.
Yeah, I would say diversification is our key risk mitigating and ability to maintain stable returns uncorrelated to the market, and we have the agility to pivot.
Yeah, for us, I think it's just, not getting over our skis. So kind of sticking with things that we know, with people that we know and that we trust, and not getting greedy when other people are, and maybe when people are a little afraid, then we'll put on a little bit of extra risk.
And Ilya, your final word?
It's great to see managers consistently reinventing themselves and always looking for perfection.
Good. That'll be our mantra for today. Okay. Thank you.
Thank you.
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.